Imagine waking up tomorrow morning, checking your phone and seeing headlines screaming that the US stock market dropped more than 10% overnight. European markets are deep in the red. Trading halts hit Asia, and crypto just plunged 40% in a single session. Every news channel is calling it the beginning of a global financial crisis, and the first thought that hits you is simple and personal. What happens to my money, my investments, my future? Today, we're not talking emotions or hype, we're talking facts. You're watching Finance Lumina. Welcome here. And in this video, we'll break down why markets crash, what history teaches us, where the world stands right now, and most importantly, whether you're prepared or exposed when the next downturn hits. What a market crash really means. A crash isn't a small 2 or 3% dip. It's when fear takes control, people sell without thinking. Liquidity dries up, banks get nervous, credit tightens, companies start failing, layoffs begin, and suddenly the entire economy feels frozen. Think about 1929, 2008, or the 2020 pandemic crash. The pattern is always similar: boom, greed, bubble, panic, collapse. In 2008, reckless lending inflated a housing bubble. Complex financial products spread risk everywhere, major institutions failed, and the system nearly broke. Markets lost half their value. Real estate sank, jobs disappeared, and families who thought they were secure saw their savings cut in half. The lesson is clear: when the US sneezes, the rest of the world catches a cold. The world in 2026. Today, the global economy looks strong on the surface, but fragile underneath. Debt levels are at records, governments are stretched, growth is slowing in many regions, interest rates are higher than they've been in years, and higher rates mean slower business activity, more loan defaults, and stress on banks. Add geopolitical tensions, trade conflicts, energy uncertainty, and rapid AI disruption that's putting millions of jobs at risk, and you get one thing: uncertainty. On top of that, many markets, especially big tech and speculative assets, look expensive. When prices run too far ahead of reality, even a small shock can trigger a sharp correction. No one can predict the exact day a crash will happen, but history shows that cycles are inevitable. After every unrealistic boom comes a reset. The real question isn't if a crash will happen, it's whether you'll be ready when it does. Is the US market safe? The US economy has strong innovation, consumer spending, and resilient companies, but it's still connected to the global system. When global investors pull money out, everything feels the pressure. During a severe correction, broad indexes can fall 30 to 50%. Smaller growth stocks usually get hit the hardest. Startups struggle to raise funding, hiring slows, and even solid businesses feel the squeeze. But here's the part most people forget: recoveries in strong economies can be surprisingly fast. Investors who stayed invested after past crashes often saw their portfolios double or triple in the following years. But who gets hurt and who wins? Crashes don't destroy everyone equally. The most damage happens to people using leverage, taking loans to invest, or gambling on short-term trades and options. When prices fall quickly, they're forced to sell at the worst possible time. On the other hand, disciplined investors who diversify, avoid debt, and keep investing calmly often come out ahead. Picture two people. One panics and sells their retirement fund at the bottom, locking in losses. The other keeps contributing monthly, buying quality companies at discounted prices. 5 years later, the second person is far wealthier. That's how wealth quietly transfers from the impatient to the patient. What you should do now: don't assume markets only go up. That's the most dangerous belief in investing. Review your portfolio and balance it across large, stable companies, some growth exposure, and safer assets. Keep an emergency fund that covers 6 to 12 months of expenses so you are never forced to sell during a downturn. Continue systematic investing even when headlines look scary, because downturns are when you buy assets on sale. Stay away from borrowed money and risky speculation. Think long-term. Great businesses survive crashes, and patient investors benefit from the recovery. Every major downturn in history created opportunities for those who stayed rational while everyone else was afraid. Markets will fall again. That's part of the cycle. But they also rise again. And those who prepare instead of panic are the ones who build real wealth. The choice is simple: live in fear of every red day, or follow a steady plan and let time work for you. At the end of the day, a crash isn't just destruction. It is a transfer of opportunity from emotional investors to disciplined ones. Subscribe.